Hi, this is Nate Williams, back with another tax deduction video. And today we're talking about misunderstood tax deductions. I'm going to go over one of the most misunderstood tax deductions out there, and that's auto expense. And today, this message is going to burst a lot of bubbles, unfortunately. I'm going to deliver a lot of bad news, but the fact of the matter is that with any tax deduction that we see or know of or hear of or see people take or are even aware of at all, there is the biggest gap between reality and expectations of reality. Or maybe it's like this: real expectations are up here and reality is down here. And that's with the auto expense. Let's get into it. Okay, here comes my slide. So, like I said, highest gap between perception of the benefit and the actual benefit. Here's the myth: you can deduct the cost of buying a car. That's the myth. The fact is that all auto deductions are limited to the business miles driven as a ratio of the total miles driven. Remember that. All auto deductions are limited to the business miles driven as a ratio of the total miles driven. So, in summary, if you buy a car and you drive it 1,000 miles and 100 miles was for business, then the expense or the tax deductible expense is 10% of the cost of that car. Now, what if you wrap the car and get your logo plastered all over the thing? Well, you can deduct the cost of the wrapping job as a marketing expense, but the cost of the car is limited to the business miles driven as a ratio of the total miles driven. So this is from the McGill top 50 year-end tax planning strategies. Sorry, I can't speak. Here's a statement. Need a new business car? You can immediately expense $28,900 of the cost of a new or used sport utility vehicle with a gross vehicle rating, GVWR, of 6,000 pounds or more. And then this fine print, assuming 100% business use. Here's another statement they make. Pay all operating expenses for your business automobile through your practice and deduct the actual cost of operation rather than the 65.5 cents per mile IRS rate in 2023. The auto expenses paid through your practice should include gas, oil, maintenance, repairs, taxes, tax license, and insurance. And then they say this: keep a log on a 3-month basis and show any personal usage as income on your W-2. So what are they saying? If you can pay all of those expenses through your practice, then you report the mileage. And this is required on the tax return. Let's say, again, to my example, 1,000 miles, only 100 miles for business, or 10% business use. What they're saying is that you need to report 90% as income on your W-2, meaning you do not get a tax deduction for it. So here's why there's a huge gap. You know, when you're talking to your kids and you say, okay, kids, after dinner, we're going to have ice cream as long as you finish all of your vegetables. What the kids hear is, after dinner, we're going to have ice cream. That's what they heard. What they didn't hear is, as long as you finish all of your vegetables. So we've got selective hearing. And with the auto deduction, there's very much a case of selective hearing. It's limited to the business use. Let me go in more depth as to what I mean. So this is required to report on your tax return. If you have an automobile that you're deducting on the tax return, you're required to report these miles. Personal miles for the whole year, which is travel on nights and weekends. Commuting miles, which is to and from work. And then also business miles. Now, these are the tax deductible ones. Now, the sum of these three are your total miles. Whatever this ratio is of business miles divided by total miles, that's the tax deductible portion. So this is a snip right here, not very pleasing to the eye, but this is directly from an IRS publication where it talks about what's deductible mileage and what's not. So from your home to your regular or main job, back and forth, is never tax deductible. from your home to a second job is never tax deductible, back and forth there too. Though that's called commuting. The IRS assumes everybody in America has to commute, and therefore it's not tax deductible. If you go from your so what constitutes business miles? If you go from your regular job to a second job, that's business miles, or a regular job to a temporary work location, that's business miles, or from a second job to a temporary work location, that's also business miles. So right now, I've got some construction happening in my house, and we've got tons of workers coming and going. My house is a temporary work location for them, and they're coming and going all the time, and they're driving from my house to another job site, to another job site, to another job site. That's all tax deductible miles for them. Or, once a quarter, Terminex comes to my house, and they drive to my house and they spray the house. The trip for them to my house, those are tax deductible business miles. But if you're going from your home to your office and back, that's commuting, not business miles. The only thing for a dentist that is really business miles would be you drive to work, and then at lunch, you go meet an orthodontist for lunch, a business meeting. The trip from your office to the restaurant and back, that would be tax deductible. Or you have to run some errands. Maybe you go to the bank. That would be tax deductible. What about if you drive to a CE course? Yes, that would be tax deductible as well. What if you stop at the bank on your way home? The deductible portion would be the additional miles that you drove outside of your normal commuting pattern. So this is not a super generous part of the tax law. And it's really designed for people who are on the road constantly driving around as part of their work. So let's go through an example here. Let's just say that you provided these mileage numbers to us, which again are required for you to report. Personal, commuting, and business miles. So it was 6,000 miles for personal, 8,000 for commuting, 960 miles for business, which I calculated to be about 5 miles a day if you're working 20 days a month. And that brings you to a total of 14,960 miles for the year, okay? The business use percentage is this 960 divided by 14,960, which is 6.4%. So how does that translate into dollars for you? Let's just say that you bought a car for $80,000 and you're depreciating it at over 5 years, so $16,000 of depreciation expense per year. And let's say your gas for the year cost $4,800, insurance was $1,800, new tires, oil changes, etc., for a total cost of $25,400. The tax deductible portion of this is only $1,630. And if you're in a 40% tax bracket, this auto deduction was worth a grand total of $652. Slow clap for the people who have the expensive auto. So just to emphasize again, if you're going to take a tax deduction for business auto, you will need to provide to us the following mileage numbers: personal, commuting, and business miles. And if audited, you'll need to provide to the IRS evidence that these miles are reasonable. We're not going to police these miles, but we're not going to invent them for you either. So what's the takeaway from here? Cars are expensive. Cars are a luxury item. Now, having a functional vehicle, that's kind of a necessity in today's world, but having a really sweet, awesome ride, that's a luxury. And the IRS doesn't really want to subsidize that for you. Most of you think that you're getting this big tax subsidy by having a business and running it through the business. I just want to break the news that you're really not getting that much of a benefit from it. We still recommend you run those costs through the business, but it's all subject to the business mileage use. Just know that, and know that if you're going to pay for the big luxury vehicle, you're going to pay for it. Hope that's helpful.